Now let's get into the very important numbers on the deflator month over month, expecting up 0.6. We end up with up 0.6, and up 0.6 is very important because in order to find a higher number than that, you have to go to June of 2008. Now, when it comes to the year-over-year numbers, that was at 6.1%, definitely higher than expected. To find a higher number than that, you're going to Dec of 1981. Now, let's look at the month-over-month deflator, personal consumption expenditure. That's up 0.5 as expected. 0.6 is the high watermark. That was in April, so it's nice to moderate from that a bit. If you look at the year-over-year number, expecting up 5.2, we get 5.2. To find a higher number than 5.2, you have to go back to April of 83. So not much easing back on the pricing issues. Now let's do our January preliminary read on durable goods. It's always volatile, Andrew, but in another week and a half to 2 weeks, we'll fine-tune it and get the numbers more clear. But right now, up 1.6%. That's much better than the 1% we were looking for. And in the rearview mirror, once again, we reversed a negative 0.7, turned it into a positive 1.2. Strip out transportation, it basically gets cut in half. You know that autos have a big function in the supply chain and a drag somewhat due to that. It drops to 0.7%. If you look at capital goods orders, non-defense aircraft, a proxy for capital investment and spending, it was up 0.9, 3 times expectations, and it gained a tenth from 0.3 to 0.4 last month. If we switch gears from orders to shipments, up almost 4 times expectations, up 1.9%, and in the rearview mirror, upgraded 0.3 last month from 1.3 to 1.6. You know, these numbers are pretty decent, and I would be surprised if we don't see a little more upside to interest rates, of course, especially if we continue to get a deeper shade of green on the equity side. Andrew and the gang, back to you.
Rick, thank you. Want to get straight over, though, to Steve Leisman, get his thoughts on these numbers. Steve?
Yeah, Andrew, thank you. I think Rick made a nice point there. They're pretty decent. The expectation was that the economy bounced back a bit from the December numbers, but not quite so strongly. And now we're seeing, as Rick points out, better numbers in durables, much better numbers on the consumer spending side. I would point out savings were drawn down, and this is amid the inflation numbers that he did cite correctly, the 5.2 on the core PCE there. It's very important that we're in this shape here because we're about to go through some dramatic uncertainty here. Some of it higher oil prices, higher energy prices, pressuring American pocketbooks. And so the issue here is how much spending declines and how much pain is felt and how Americans are able to withstand it. And all of this, of course, paling between the in front of the pain being felt over in the war zone there. But the impact here is going to be on from higher prices, at least initially. So we have a bounce back that we expect to be coming from Omicron and the shutdowns from that. So overall, we're going into a period of high uncertainty, in better economic shape and an accelerating economic shape. So in terms of the sacrifices here that need to be taken, I think the U.S. consumer is in reasonably good shape, if not a good mood, to withstand them.